For impairment of financial assets, Ind AS 109 provides us three approaches to recognize the impairment allowance on the financial instruments. One is the first is the general approach, second is simplified approach, and third one is purchased or originated credit impaired financial assets approach. In case of general approach, entity is required to recognize at each reporting date using 12 months expected credit loss or lifetime expected credit loss method. In this case of 12 months ECL approach, typically the amount of the impairment loss is lesser because we are estimating the loss over a period of 12 months from the reporting date, while in case of lifetime ECL method, the amount of impairment loss allowance may be higher because we are estimating the chances of loss probability of default over the life of the instrument. It may be 5 years, 10 years, or 15 years. And this general approach is applicable to all the financial instruments except those are covered under simplified approach or purchased or originated credit impaired financial assets approach. In case of simplified approach, we are not required to track the changes in credit risk at each reporting date as compared to general approach. In simplified approach, we need to recognize impairment loss on the lifetime ECL at the initial recognition only. In general approach, we are recognizing the impairment loss at each reporting date, but in simplified approach, we need to recognize impairment loss at initial level only. And the simplified approach is mandatory for trade receivables or contractual right to receive cash or other financial assets. Those are not having major financial component and are within the scope of Ind AS 115. And we have accounting policy choice for the financial assets. Those are lease receivables or trade receivables or contract assets within a scope of 115 and are having major financial components. In this case, we can either use the general approach or we can use the simplified approach for recognition of impairment loss. And once the approach we have decided, we need to apply it consistently, and we need to apply the chosen approach, either general approach or simplified approach, on all the items in that bracket, and it cannot be applied selectively. And the third approach, that is called purchased or originated credit impaired financial assets approach. This approach is applicable to the financial assets which are credit impaired at the time of purchase or origination.